Think about this for a moment. Every February, somewhere in your inbox or your mailbox, a small slip of paper arrives. It has your name on it, your employer's name, and a set of numbers that will determine how much of your money the federal government gets to keep. You fill out the forms, you do the math, or you pay someone to do it for you, and then you wait. It is one of the most universal experiences in Canadian life. It feels as permanent and inevitable as winter. But here's the thing, for the first 50 years after Canada became a country, none of that existed. Not the T4 slip, not the income tax form, not the federal government reaching into your earnings, none of it. From July 1st, 1867, when Confederation created the Dominion of Canada, until the summer of 1917, the federal government in Ottawa ran the entire country without collecting a single dollar of personal income tax. 50 years. 2 generations of Canadians who lived their entire lives without ever filing a return. So how did it work? How did Ottawa build railways, fight wars, settle a continent, and keep the lights on without the revenue engine we now consider essential? And when it finally changed, how did one man in one afternoon, in a House of Commons speech that lasted less than an hour, introduce a measure he himself had spent years arguing against and set in motion something that has never stopped? The answer is far stranger, far messier, and far more revealing than most people realize. It is a story about tariffs and tobacco, about nation building and borrowed money, about young men's bodies and wealthy men's incomes, and about a word that Finance Minister Sir Thomas White was very careful never to use. The word was temporary, and the reason he left it out tells you almost everything you need to know about how governments actually work. To understand why Canada spent its first 50 years without an income tax, you have to go back to the very beginning, not to 1917, not even to the war. You have to go back to the room in Charlottetown, where the whole thing started. In 1864, the men who would become Canada's fathers of Confederation were not just designing a country, they were designing a financial system. They were sitting down with ledgers and arguments, trying to figure out how a new federal government would pay its bills without bankrupting itself or alienating the provinces it was trying to unite. And the answer they landed on was customs and excise duties. The logic was straightforward. Canada, in 1867, was a trading economy. Goods moved across borders constantly. Ships arrived in Halifax and Quebec City, loaded with British manufactured goods, and every one of those goods could be taxed at the point of entry. No complicated assessment, no intrusive inspection of individual citizens' private finances, just a toll at the border. The Constitution Act of 1867 gave the new federal government exclusive authority to levy customs and excise duties, while leaving direct taxation largely to the provinces. That was not an accident. It was a deliberate design choice, and it reflected a very specific theory of what the federal government was for. When the Dominion opened for business on July 1st, 1867, its annual budget was $14 million. Its net debt was $75.7 million, inherited from the provinces of Canada, Nova Scotia, and New Brunswick. And its plan for paying that debt, funding the civil service, and building the infrastructure of a new nation was to collect money at the border. That was the founding bargain. And for the first decade of Confederation it held. Now, the man who would turn that founding bargain into something much more ambitious was John A. Macdonald. Macdonald was Canada's first Prime Minister, and he understood something that not everyone in his cabinet did. He understood that customs duties were not just a revenue tool. They were a nation-building instrument. If you taxed imported manufactured goods at a high enough rate, you did two things at once. You filled the federal treasury, and you forced Canadians to buy Canadian-made goods instead, which meant you grew Canadian industry, which meant you employed Canadian workers, which meant you could attract the immigrants you needed to settle the vast Western territories you had just acquired from the Hudson's Bay Company. On March 14, 1879, MacDonald stood in the House of Commons and introduced what he called the national policy. It raised tariffs on imported manufactured goods to between 25 and 35%. A coat made in England and shipped to Toronto would now cost significantly more than a coat made in Hamilton. The policy was controversial. Critics called it a tax on consumers. Supporters called it the spine of the Canadian economy. But whatever you called it, it worked, at least as a revenue mechanism. Customs duties flooded into the federal treasury. They funded the construction of the Canadian Pacific Railway, completed in 1885. They funded the Northwest Mounted Police. They funded the settlement of the prairies, and they kept coming. By 1891, when MacDonald fought his last election campaign explicitly defending the national policy, customs and excise duties were still the engine that powered everything Ottawa did. When Wilfrid Laurier's Liberals swept to power in 1896, they kept the same tariff structure in place. The names on the office doors changed. The revenue model did not. By 1913, customs and excise duties still provided more than 90% of all federal revenue. The income tax-free model was not just a policy choice at that point. It was a way of life, an ideology, a promise embedded in the very architecture of the Canadian state. The reason Ottawa was so committed to keeping things this way was not simply inertia. There was a real strategic argument against income tax that Canadian politicians and financiers made repeatedly and sincerely for decades. Canada needed immigrants, hundreds of thousands of them, to farm the prairies, build the railways, and fill the growing cities. And one of the things Canada could offer those immigrants, particularly the ones coming from countries where direct taxation was already a fact of life, was low taxes. No income tax was a selling point, it was part of the pitch. Come to Canada, work hard, and the government will not reach into your pocket to take a share of what you earn. That argument was not cynical. It was the founding logic of the Canadian revenue model, and it was still being made in cabinet meetings as late as 1916. Into this world came Sir Thomas White. His full name was William Thomas White, and he was born on November 13, 1866, in the small town of Bronte, Ontario, near Oakville. His background was unusual for a finance minister. He had been a journalist. He had worked as a tax assessor for the city of Toronto, which gave him a precise technical understanding of how taxation actually worked at the ground level. He had moved into finance and become a successful businessman. He was not a politician by instinct. He was a problem solver, careful and methodical, the kind of man who read the fine print. White was appointed finance minister on October 10, 1911, when Robert Borden's Conservatives won the election that toppled Wilfrid Laurier's long-serving Liberal government. One of the key issues in that election had been Laurier's proposed reciprocity agreement with the United States, a free trade deal that alarmed Canadian manufacturers who had built their businesses behind the national policy's tariff wall. Borden won partly by promising to defend that wall, and White, as finance minister, was the man responsible for keeping it standing. For the first 3 years of his tenure, White managed the federal finances competently and quietly. Then, in August 1914, everything changed. Britain declared war on Germany on August 4, 1914, and Canada, as a dominion of the British Empire, entered the war automatically. Prime Minister Borden pledged Canadian support. The expectation in Ottawa, as in London and Paris and Berlin, was that the war would be short. A few months perhaps, it was not, and the financial consequences of that miscalculation would reshape Canada's fiscal architecture permanently. In the fiscal year before the war, Canada's federal budget stood at roughly $185 million. That was already a significant increase from the $14 million budget of Confederation, reflecting 4 decades of growth, immigration, and nation building. But the war consumed money at a rate that no one in Ottawa had planned for. By the war's peak, the federal budget had quadrupled to more than $740 million. Federal debt quadrupled to $1.2 billion. The customs duties that had funded everything for 50 years were simply not enough. They could not be made enough. You cannot raise a tariff high enough to pay for a world war. White's first move was to borrow. Ottawa went to London first, tapping British credit markets that had financed Canadian railway construction for decades. But Britain was fighting its own war, and British credit was not unlimited. White then turned to New York. In the summer of 1915, Canada secured a $40 million loan from American banks at interest rates of between 5 and 5.25%. It was the largest external borrowing Canada had ever attempted, and it was not enough either. And then White tried something that had never been done before on this scale in Canadian history. He asked Canadians to lend their government money directly. In November 1915, Ottawa launched its first domestic war bond drive. No bond issue in Canadian history had ever raised more than $5 million. White's team set a target of $50 million, which was already considered ambitious. The drive raised $100 million, twice the target, 20 times the largest previous Canadian bond issue. Canadians lined up at their banks and post offices to buy bonds, farmers in Saskatchewan, factory workers in Montreal, shopkeepers in Victoria. The response was, by any measure, extraordinary. Between 1915 and 1918, 5 domestic bond offerings raised more than $1.7 billion from Canadian citizens. The war was being financed, increasingly, not by foreign lenders or by tariff revenue, but by the savings of ordinary Canadians. By the end of the war, Canada had incurred more than $2 billion in debt, and most of it was owed to Canadians themselves rather than to foreign creditors. That was a source of some national pride. It was also a source of enormous ongoing financial pressure. In 1916, White introduced the Business Profits War Tax Act. This was a tax on corporate profits, not on personal incomes, and White was careful to build in a time limit. The act explicitly applied to profits earned from 1914 through 1917. It would expire. It was a wartime measure, and it was framed as one. White was still holding the line on personal income tax. Then came April 1917. In his budget speech that month, White stood in the House of Commons and explicitly ruled out a personal income tax for the immediate future. He gave 2 reasons. First, he said it would not raise enough revenue to justify the administrative burden. Second, he argued that many Canadians were already paying provincial and municipal income taxes, and adding a federal layer would be too heavy a burden. His position was clear: no personal income tax, not now. He would reverse that position completely within 90 days. To understand what changed, you have to understand what was happening in the spring of 1917 on the Western Front. Robert Borden had visited the Canadian troops in France and Belgium. He had walked through the field, hospitals, and the forward trenches. He had looked at the casualty lists. By early 1917, Canada had committed to maintaining a force of 500,000 men. Voluntary enlistment had slowed to a trickle. The men who had signed up in the flush of patriotic enthusiasm in 1914 and 1915 were dead or wounded or exhausted. New volunteers were not coming forward in sufficient numbers. Borden concluded that Canada had no choice. It would have to conscript men. The Military Service Act was introduced in Parliament in the spring of 1917. It was one of the most divisive pieces of legislation in Canadian history. French Canadians, who had never felt the same attachment to Britain that English Canadians did, opposed it bitterly. Henri Bourassa, the Quebec nationalist and founder of the newspaper Le Devoir, led the opposition in the press. Wilfrid Laurier, now leader of the Liberal opposition, opposed it in Parliament, arguing that it would tear the country apart. He was right, and he knew it, and he opposed it anyway. The Military Service Act passed on August 29, 1917. It made men between the ages of 20 and 45 liable for conscription. In total, 404,385 men, became liable for service. Of those, 385,510 applied for exemption. In Quebec, 93% of those who registered applied for exemption, but the Military Service Act also created a political problem for the government, and it was a problem that Thomas White had to solve. If the government was going to conscript men's bodies for the war, how could it justify not conscripting wealthy men's incomes? The argument was being made publicly, in newspapers and in Parliament. You can't ask a farm boy from Ontario to give his life and ask a factory owner in Toronto to give nothing beyond what he was already paying in tariffs. The moral logic was difficult to answer. White understood this, and on July 25, 1917, just days after the Military Service Act debate had reached its most heated point, he rose in the House of Commons at 3 o'clock in the afternoon and introduced the Income War Tax Bill. He called it a conscription of wealth. The phrase was deliberate. It linked the income tax directly to the conscription of men, creating a moral equivalence that was politically difficult to oppose. If you supported the war, and if you supported asking young men to die for it, then you should support asking wealthy men to contribute financially. The argument was elegant and it was effective. But listen carefully to what White actually said about the duration of the measure. He did not call it temporary. He did not put a time limit on it, the way he had explicitly time-limited the business profits war tax of 1916. What he said was this: "I have placed no time limit upon this measure. I think it is probable that the measure should be reviewed a year or two after the war is over." Read that again. He said it should be reviewed, not repealed, not ended, reviewed. And he placed no time limit. The contrast with the 1916 Act, which he had explicitly restricted to profits earned during the war years, was not accidental. White was a careful, precise man. He knew exactly what words he was using and what words he was leaving out. The parliamentary debate that followed was illuminating. Several Liberal members of Parliament spoke in support of the bill. At least one of them, speaking from the opposition benches, predicted openly that the income tax was not going anywhere once the war ended. He said so not as a warning, but as a celebration. He thought a permanent income tax was a good idea. He was not alone. The rates set out in the original act were modest by modern standards. A flat tax of 4% applied to income above $1,500 for single individuals and unmarried widows and widowers without dependent children. For everyone else, the exemption was $3,000. A progressive surtax applied to higher incomes, starting at 2% on incomes above $6,000 and climbing to 25% on the very highest incomes. In $2,020, that $1,500 exemption was equivalent to roughly $30,720, and the 25% top rate did not kick in until income equivalent to over $2 million in modern terms. Under these thresholds, only somewhere between 2 and 8% of Canadians were required to file a return at all. The vast majority of the population would never see a form. The Income War Tax Act received royal assent on September 20th, 1917. The document was 11 pages long. 11 pages. You could read it in 20 minutes. It was a lean, spare piece of legislation, written quickly, in a crisis, by a man who had spent years arguing it should never exist. The political crisis that surrounded the income tax did not end with royal assent. It deepened. The December 1917 federal election was fought almost entirely on the question of conscription. Borden ran as the leader of a new unionist government, a coalition of conservatives and pro-conscription liberals. Laurier led the anti-conscription liberals. The election split Canada along lines that had been building for decades. In English Canada, Borden won decisively. In Quebec, he was crushed. The Unionists won only 3 seats in the province. Laurier carried Quebec but lost the country. It was one of the starkest linguistic and regional divisions in Canadian electoral history, and it left wounds that took decades to heal. The winter of 1917 and the spring of 1918 brought the crisis to its worst point. At Easter 1918, anti-conscription riots broke out in Quebec City. For 4 days, crowds gathered in the streets. The riots turned violent. Federal troops were called in. When it was over, 4 civilians were dead, and dozens more were injured. The conscription crisis had not just divided English and French Canada politically, it had produced bloodshed on Canadian streets. And then, on November 11, 1918, the war ended. In 1919, the federal government tallied up what the new income tax had actually produced. The answer was sobering. Personal and corporate income taxes combined accounted for just 3.4% of total federal revenues that year. The war had ended before the tax machinery could fully crank up. The vast majority of Canadians had paid nothing under the new act. Customs duties were still doing the heavy lifting. White himself resigned as finance minister on August 1st, 1919, exhausted by 8 years in the role and worn down by the war's financial pressures. He had managed Canada's finances through the most expensive conflict in the country's history. He had presided over a quadrupling of the federal budget and a quadrupling of the national debt. And he had introduced, in 11 pages, a measure that would ultimately transform the Canadian state more thoroughly than anything else he had ever done. The question everyone in Ottawa was asking in 1919 was straightforward. Now that the war was over, would the income tax be allowed to expire, as so many had assumed it would? The answer came gradually, and it came in numbers rather than in legislation. In 1920, Ottawa introduced a manufacturer's sales tax to help cover the ongoing costs of veterans' pensions and interest payments on the war debt, another temporary measure said to be reviewable once conditions permitted. In 1921, Statistics Canada published a figure that settled the question more definitively than any parliamentary speech could have. In the fiscal year ending March 31st, 1921, for the first time in Canadian history, revenue from direct taxes exceeded revenue from customs duties. Direct taxes brought in $168,385,327. Customs duties brought in $163,266,804. The difference was roughly $5 million, but the direction was unmistakable. The fiscal order of Confederation had been reversed. The tariff wall that MacDonald had built in 1879, the wall that had funded everything for 4 decades, had been surpassed. Not abolished, not dismantled, just surpassed. The income tax, introduced as a wartime emergency measure by a man who had ruled it out 3 months before he introduced it, had become the primary engine of federal finance in just 4 years. And yet, remarkably, the income tax still had no formal permanent status in Canadian law. White had not called it temporary, but he had not called it permanent either. He had said it should be reviewed. It had not been reviewed. It had simply continued year after year, as governments found that the revenue it generated was too useful to give up, and as the debt from the war made giving it up practically impossible anyway. As late as 1938, only 2.3% of the Canadian population filed income tax returns. The tax was still, in practical terms, a levy on the relatively affluent. The vast majority of Canadians had no direct experience of it, and yet it was growing. The rate structure was expanding. The exemption thresholds were shifting. The administrative machinery was becoming more sophisticated. It was not until 1949 that Prime Minister Louis Saint Laurent formally made income taxes permanent in Canadian law, 32 years after the 11-page wartime measure had received royal assent. 32 years of a supposedly reviewable, non-time-limited emergency instrument quietly becoming the foundation of the Canadian fiscal state. By 1946, a special Senate committee had overhauled the income tax system, and direct taxes already accounted for more than 56% of federal revenue. The customs duties that had funded everything from Confederation to the First World War were now a secondary source. By 2017, personal income tax alone accounted for an anticipated 51% of all federal revenue. The 11 pages had grown to over 3,500. The 2.6% share of federal revenue that income tax represented in 1918 had become the single largest source of money Ottawa collects. and nearly 75% of Canadians now file returns compared to the 2 to 8% who were required to do so under the original act. Think about what that trajectory means. In 1917, the income tax was a measure that touched almost no one. It was aimed at the wealthy, framed as a wartime emergency, and designed by a man who had publicly opposed it until the moment he introduced it. Today, it is the central financial relationship between the Canadian state and the Canadian citizen. It is the mechanism through which more than half of everything Ottawa spends is collected. It is the form in your inbox every February. The story of the Income War Tax Act is not really a story about war finance. The war was the occasion, but it was not the cause. The cause was something older and more structural. The gap between what a modern industrial state needs to do and what a tariff wall can pay for. MacDonald's national policy was a brilliant solution to the problems of 1879. It was not a solution to the problems of 1917. No tariff rate in the world could have funded the Western Front, but the story is also about something else. It is about how emergencies become permanent. It is about how governments, when they find a revenue source that works, do not let it go. White was careful not to call his measure temporary. He was careful not to time limit it. And the Liberal MP who stood up in the debate and predicted that the income tax would outlast the war was not cynical. He was just paying attention. The T4 slip that arrives in your inbox every February is the direct descendant of that 11-page document. The rates are different. The thresholds are different. The administrative machinery is incomparably more complex. But the legal and political DNA is the same. It was introduced in a crisis by a man who had argued against it, framed as a conscription of wealth to match a conscription of men, and left without a time limit by someone who chose his words with great precision. The question, Thomas White said, should be reviewed, whether the measure was suitable to the conditions that then prevailed, has never been formally answered. The conditions of 1917 no longer prevail. The war ended more than a century ago. The men who were conscripted are long dead. The debt that forced White's hand has been paid many times over and replaced by new debt. The review has simply never come. And that is not a small thing. The review is not just a procedural formality that got lost in the paperwork. It is the central unanswered question of Canadian fiscal history. Because what White was really asking when he said the measure should be reviewed was this: who decides when an emergency is over? Who holds the authority to look at the machinery of government finance and say the conditions that justified this no longer exist, and therefore this ends? The answer, it turns out, is nobody. Or more precisely, the people who would have to make that decision are the same people who benefit most from not making it. Consider the arithmetic. In the fiscal year ending 1921, direct taxes exceeded customs duties for the first time. By 1946, they accounted for more than 56% of federal revenue. Every government that came to power between 1918 and 1949, liberal or conservative, looked at the income tax, looked at what it produced, and decided that reviewing it could wait another year, and then another, and then another. By the time Saint Laurent formally made it permanent in 1949, the question was almost academic. Nobody seriously believed it was going anywhere. The formalization was not a decision. It was an acknowledgement of what had already happened while nobody was officially paying attention. And the growth did not stop in 1949, it accelerated. The original act had been lean by necessity. White wrote it fast, in a crisis, with a narrow target. Wealthy individuals, high incomes, a small slice of the population. But tax codes do not stay lean, they accumulate. Every budget, every amendment, every court challenge, every new economic circumstance adds another layer. Exemptions get added and removed, credits get introduced. Deductions get created for one purpose and then exploited for another. The 11 pages of 1917 became, through successive reforms and revisions, the 3,500-page document that tax professionals navigate today. That growth is not random. It reflects something real about how power operates in a democratic system. Every time a government wants to encourage a particular behavior, it reaches for the tax code. Build a factory in a depressed region, and we will give you a deduction. Invest in research and development, and we will reduce your burden. Contribute to a registered retirement savings plan, and we will defer your tax. Each of these decisions is defensible on its own terms. Together, they produce a document of staggering complexity that very few Canadians can read without professional help. Now, the original act had none of this. White's 11 pages were almost elegant in their simplicity. You earned above a certain threshold, you paid 4%. If you earned significantly above that threshold, you paid a progressive surtax that climbed to 25%. There were no registered accounts, no capital gains calculations, no foreign income provisions, no alternative minimum tax. There was a number, a rate, and a payment. A farmer in Manitoba or a factory owner in Hamilton could, in principle, understand exactly what was expected of them. That simplicity did not survive contact with the Canadian economy. By 1920, Ottawa had already added a manufacturer's sales tax, another supposedly temporary measure that became a permanent fixture of the revenue landscape. By the 1940s, the Second World War had done to the income tax what the First World War had done to the tariff system. It had expanded it beyond recognition. Top marginal rates climbed sharply during the Second World War as the government needed even more revenue. The administrative infrastructure grew to match. The Canada Revenue Agency, in its various earlier forms, went from a small department processing returns from a tiny fraction of the population to one of the largest bureaucratic operations in the federal government. And the population filing returns grew with it. In 1917, somewhere between 2 and 8% of Canadians were required to file. As late as 1938, only 2.3% of the population actually did, but the exemption thresholds did not keep pace with rising wages. As ordinary workers earned more of them crossed the filing threshold. By the post-war decades, income tax was no longer a levy on the wealthy. It was a levy on almost everyone who worked. The founding promise of Confederation, that the federal government would fund itself at the border, rather than by reaching into individual Canadians' earnings, had been not just reversed but buried. The men who designed Confederation in 1864 and 1867 were not naive about taxation. They understood that governments need money. What they were trying to avoid was a particular kind of relationship between the state and the citizen, the direct, visible personal extraction of a share of individual income. Customs duties were tolerable precisely because they were indirect. You paid them without knowing you were paying them, folded into the price of a coat or a piece of machinery. They were, in that sense, the hidden machinery of government finance. The income tax made the machinery visible. It put a number on what the state was taking from you personally by name in a document you had to sign. That visibility is why income tax was so politically difficult to introduce, and why it was introduced only under the cover of a war emergency and the moral pressure of conscription. White needed the war. He needed the framing of the conscription of wealth. Without that framing, the political resistance would have been formidable. Even with it, the debate in Parliament was heated, and the Liberal opposition under Laurier was deeply conflicted. Some members supporting the tax enthusiastically, others accepting it reluctantly, and Laurier himself focused far more on the conscription crisis than on the fiscal measure attached to it. The conscription crisis itself is worth sitting with for a moment, because it shapes the context in which the income tax was born, and because its consequences ran so much deeper than the tax itself. The Military Service Act passed on August 29, 1917. Of the 404,385 men who became liable for service, 385,510 applied for exemption. In Quebec, 93% of those who registered applied for exemption. The province did not believe this was its war. Henri Bourassa had been arguing for years that French Canadians owed nothing to the British Empire. that their loyalty was to Canada and to Quebec, not to a colonial relationship with London that most of them had never chosen. The conscription crisis proved him right in the eyes of hundreds of thousands of Quebecers, and it proved Borden's government wrong in a way that echoed through Canadian politics for decades. The Easter riots of 1918 in Quebec City were not an isolated eruption. They were the visible surface of a fracture that ran through the entire country. 4 civilians killed in the streets of a Canadian city by federal troops enforcing a conscription law that the city's population had overwhelmingly rejected. The income tax, introduced in the same political moment and justified by the same war logic, carried some of that weight with it. In Quebec, the legacy of 1917 was not just fiscal. It was constitutional, political, and deeply personal. Borden's Unionist government won the December 1917 election, but it won by dividing the country along lines that had not been that stark since Confederation itself. English Canada voted for conscription and the war effort. Quebec voted against. The Conservatives would not win a majority government in Quebec again for decades. The political cost of 1917 was paid not in a single election, but in a generation of fractured national politics. And through all of this, the income tax quietly continued. It did not produce much revenue in its first years. In 1919, income and corporate taxes together were only 3.4% of federal revenue. The administrative machinery was new, the filing population was tiny, and the rates were modest. But it was there. It was functioning. And every year that it continued without being reviewed, without being wound down, without the promised post-war assessment that White had spoken of, it became a little more permanent. By 1921, when direct taxes exceeded customs duties for the first time, the question was settled in practice, even if not in law. The fiscal order that MacDonald had built, the order that had funded Confederation, the CPR, Western Settlement, and the first 50 years of the Canadian state had been superseded. Not by a grand parliamentary debate or a constitutional amendment or a deliberate act of policy. It had been superseded quietly, incrementally, by the compounding logic of a wartime emergency that never formally ended. White lived until 1955. He watched the 11-page act he had introduced grow and expand, and become something far beyond what he had written in the summer of 1917. He had been appointed to the Senate in 1930, where he served until his death. He never publicly expressed regret about the Income War Tax Act, but he also never claimed credit for creating a permanent institution. He had introduced a measure he said should be reviewed. The review never came. That silence, that absence of the review he had promised, is perhaps the most consequential thing about his legacy. The story of the Income War Tax Act is not really a story about war finance. It is a story about how emergencies become permanent, how the most durable word in the language of government is not forever, but for now, and about the distance between what a politician says in a crisis and what actually happens when the crisis ends. It is a story about a founding bargain made in 1867 by men who believed they had found a way to fund a nation without reaching directly into its citizens' pockets, and about how that bargain held for 50 years before a single afternoon in the House of Commons changed it for good. The T4 slip in your inbox every February is the direct descendant of those 11 pages. The rates are unrecognizable, the complexity is incomprehensible, but the legal and moral architecture is the same one White built in 1917, justified by conscription, framed as temporary in spirit, while deliberately left open-ended in law, and never subjected to the review its author said it deserved. The question White left on the table, whether the measure was suitable to the conditions that then prevailed, has never been formally answered. The conditions of 1917 are gone. The war is a century past. The debt that forced his hand has been repaid and replaced many times over. And yet the measure remains. Not because anyone decided it should be permanent, but because no one ever decided it should end. That is not a small distinction. That is the hidden machinery of the Canadian state, hiding in plain sight, in the document you sign every spring.